I think it's been very surprising at how weak the Chinese economy has been for most of this year, when actually people were expecting that sort of post-COVID, similarly to many other major economies around the world, there would be this boost, but that's failed to materialize. So I think the Chinese government stepping in and supporting the economy is a necessity for domestic economic growth, and it should hopefully provide a bit of a boon for the stock market as well, which we've already seen today.
Right. Do you think that there's reason enough to look at Chinese stocks at this point? Are investors asking you about whether to get into China at these levels?
It's undoubtedly, Chinese shares are incredibly cheap based on a variety of metrics. Part of that definitely is the economic slowdown that we've seen, and sort of post-COVID as well. But a large portion of that is the political risk and geopolitical risk that is associated with that market. I think taking maybe a short-term view, that I think China is definitely one to have a look at. But I think at the back of most investors' minds is the political and geopolitical risk that has been present in China and may be present in the future as well. But from a short-term perspective, I think it looks interesting.
Hey, Dan, look, you're looking at valuations and you're looking at gilts and fixed income. Quite frankly, anyone who's bought gilts thinking they were high yield at the start of the year has had a rubbish trade, and the coupon's been wiped out by the underlying decline. Now's a better time to buy?
Yeah, I mean, the 10 years at 4.25 at the moment. We've started to see some green shoots on the inflation figures, 7.9% last week, slightly below consensus and forecast. Inflation will continue to fall. It will be a rocky and bumpy road, but it will fall. And I think taking a medium to long-term view, locking in yields north of 4%, I think is going to serve investors as well, especially if you do think that the economic recovery or the economic performance of the country might be a little poorer than expected, just given the sheer scale of interest rate increases we've seen over the last 18 months.
Yeah, does that mean equities are the other side of the trade, or how does the barbell look at the moment, Dan?
I think in the short to medium term, I think fixed interest looks a lot more interesting than equity markets. It's amazing. I think, if we look at the American market, it's up sort of circa 20% year to date. And actually, the economic conditions have not, I don't think, been getting terribly better. Yes, inflation has been coming down, but actually earnings estimates and revisions for the vast majority of the S&P have been, steadily falling this year. What's saved the market so far is the advent of AI and the Magnificent Seven technology stocks, which have just roared ahead and sort of saved the stock market. But I think the outlook is still relatively challenging for equities. And so in the short to medium term, I'd more be in favour of fixed interest.